You make the argument that equities are signaling that we could see more movement in the bond market, and that might not actually be the worst thing. I want you to break that down for us.
Yeah, so, I think that there's this narrative out there that a movement up in interest rates and yields is negative and sort of mutually exclusive for equity portfolios. But if you actually look at history, take the last 25 years of history, and you look at those periods in which the 10-year has moved, and we're talking about twice what it's moved in the last little bit, has moved 100 basis points. In 100% of those cases, equities have continued to rally. And again, I think that there's this conflict between, certainly if we expect major inflation and that is the cause of the move in yields, then that is a negative to the extent that the Treasury is focused specifically, the Treasury and the Fed are focused specifically on that. But that's not where we are. We are in a situation where we are all expecting synchronized global growth, and that growth is the reason that the interest rates are moving. And so that is going to buoy the equity markets as well.
Yeah, Phil, I want to get your take right now. I mean, you make the point that March 3rd, which is tomorrow, is going to mark the one-year anniversary of the first emergency rate cut from the Fed in the midst of this pandemic. And my goodness, what a year it's been. I mean, meantime, we're getting some bubble-ish warning talk out of a number of entities right now, whether it's China, whether it's this indicator out of Bank of America as well, that we could be close to a sell signal. I mean, there's a few other things to point out here. How do you see this moment we're in, this market moment we're in, and how are you positioned for it?
Yeah, Morgan, talk about a seismic narrative shift. I mean, a year ago it was, oh my goodness, how quickly are things getting worse? To today being, oh my goodness, how quickly are things getting better, right? And I think that interest rate move that was described a minute ago is part of this. However, our outlook really relies on accommodative financial conditions. What are those? Well, the stock market behaving, credit spreads hanging in there. They're very, very tight. Interest rates remaining very accommodative, as well as volatility. And I really want to point on that for a second, because, Morgan, there's still $700 billion in money market funds post-pandemic. And if you think about the money that's going to be put to work from President Biden's fiscal plan, we're talking about $1 trillion just sitting on the sidelines, waiting for any pullback to jump in. But really, the reflationary theme is alive and well. All reflation means is that you have low inflation rates and it gets the Fed's target, and the Fed upped their target through their average inflation framework. So what we're looking at here is pro-small cap, driven by the best growth that we're going to see in the United States in 35 years. So that's something that investors should certainly pay attention to. And then the emerging market equities theme is also alive and well in that kind of coordinated global growth theme. So this is all pointing out to be a really, really good year, a dramatic return to normalcy and reopening, and all of the things to be excited about within the equity market.
Shepard Smith here. Thanks for watching CNBC on YouTube.